Hello, ladies and gentlemen. I just wanted to do a very quick update on what happened last week and what we can expect next week with the Trump inauguration. Who knows about that? But let's have a look at what happened. Basically, the yield curve moved in parallel between the 2s and 30s, 10 basis points coming in because CPI and PPI were not as bad as people feared. What had happened? The big houses ramped up their expectations for CPI and PPI, and the numbers actually came in as they would have been without that ramp. So the market went back exactly to where it was before the ramp in expectations for inflation. PCE is going to be 1.7, 1.8, which is no deviation from what it has been recently. So can anyone say that inflation is improving? No, they cannot. Can they say that the economy is weak from all the other figures that we had? No, they cannot. The economy is strong. There seems to be absolutely no increase in unemployment that one can discern from the weekly claims or the continuing claims. And inflation continues to be a problem at the levels that we are. So that's all that one can say. Therefore, it's a period of stability in the bond market. If one looks at what 30s did, the 30s basically just got to 5%. There were buyers there. The market backed off 10 basis points, and that's it. The ones that moved more were the 5s and the 10s because they'd been hit so much more. So all that means is the 2s, 5s, 30s butterfly basically came in, and 2s, 30s were completely unchanged, and the 5s moved in a bit in terms of yield, and the butterfly went to where it was before all of this started happening. So really a nothing kind of week in the bond market, and that's all that one can say. Now, when are the significant events coming up? Well, one is the potential executive orders as of Monday, which are regarding immigration and tariffs. Either way you look at it, they're not deflationary, they're inflationary, and they tend to boost the steepness of the curve. But the really big event is going to be at the end of January and beginning of February, which is the QRA. Let's have a look at what happened at the last QRA back here in November, and that is of 2023, and that is when Yellen decided to do her twist. And she decided to issue less at the longer end and more at the front end. And this is what the 30s did. And where are we now? We are right back to where we were before she decided to do that. Now, the Republicans in general have complained about that move. So if they want to undo it, Besant has a chance already on I believe it's the 2nd of February, but don't quote me on that. Will he do it? I have no idea. But if he wants to send a message, that's when he'll send the message. Will he have enough time to get his feet under the desk by then? I don't know. So it could be the QRA after that. But I just know that that is a date by which I want to have almost no positions and be ready to respond. Because if he does twist the other way, the 30s are going to go parabolic to at least 5.25%, 5.5%, without a doubt in my mind. So if you go on a weekly and have a look here, I think that we could easily go to 580, okay, in the 30s if he were to twist the other way from Yellen. Will he do it? I have no idea, but I'm prepared for that to happen. In the meantime, I don't think much happens unless these executive orders from Trump are completely different from what the market expects. And again, I think most of this move in the past 6 weeks has been front-running what they think the first executive orders are going to be. So I don't think that the market is going to be very volatile next week, because really these executive orders on tariffs and immigration are 99% priced in. It's only if they're really, really outside of the realms of what the market thought was possible that we're going to get big moves at the long end in bonds. And therefore, I don't think that we're going to get big moves in anything else. And let's have a look at those relationships. Here we have SPY TLT, and basically it traded 1-for-1 with bonds last week. As you can see, we are waiting for news for this spread to move. Basically, we are stuck. Bonds and stocks, they are the same thing at the moment. If one has a look at ITOT over government, it's more or less the same thing. This is looking even more bullish to me. But we're looking for a break of the highs so that equities can outperform bonds for quite some time. If we look at RPAR, which is also interesting, all we had last week was basically both bonds and stocks rallying and working off these very oversold indicators that we had on RPAR. RPAR seems stuck to me. It just telling me that bonds aren't going to go very far, and they're not going to therefore allow equities to go very far. We are in a consolidation period waiting for this move. And as I told you, I think that move potentially comes at the end of the month with a QRA. It's less likely to happen next week with the Trump executive orders, because those are mostly in the market. It would have to be something very, very different from market expectations to start having RPAR break down through this 1830 level, which I think is very, very important, because I think it's far more likely that we go sideways for a few weeks and then decide which way RPAR goes, rather than busting to the downside immediately. And that is why I think we're in for a period of relative stability in the bond market in the next several weeks, which should allow equities to start breaking upwards. Because if there's no bad news from the bonds, I think the equities are likely to go and make new highs, and therefore get a 5 to 10% move in equities while bonds move sideways. And especially if the QRA is neutral, i.e. he adopts a QRA which is exactly the same as Yellen would have done, i.e. no counter twist, then I think it's far more likely that people say, okay, these guys aren't going to change anything, and let's just let's buy equities over bonds. Why would you be buying bonds only 40-50 basis points above Fed funds? Yeah, okay, and then what? Do we have the Fed cutting? Well, I don't think the Fed can cut until probably March. And in that case, bonds will be stable and people will look forward to the cuts by buying equities. That's my guess. But that is why I'm watching SPY TLT, I'm watching ITOT government, and I'm watching RPAR, which to me is far more likely to be able to get back to these neutral levels around 1937 than break down. But if it breaks down, or even if SPY TLT starts breaking down, then we know what to do. But for the time being, I just see absolutely no reason for why that should happen. Well, if I'm correct that the last leg up in bonds was front running of the tariffs and the immigration policies of Trump, then this last move in the Dixie from 105 3/4 up to 109 110 is also the same thing. If we have front run them already, the likelier path is that we get a bit of a spike and then start coming back towards this 108 level and then wait around that 108 level after we have seen what the executive orders are. So I'm not bullish on the dollar, and that tells me that the bonds are going to be rather stable or relieved that things haven't been, aren't worse than they expected. If, on the other hand, we start breaking upwards, we probably can go all the way up to 114. So the risk reward is not there to sell the dollar. It's not to get too far ahead of oneself, and really not to take the bait of buying it first time around until one has seen that it's really far more consequential than the market has already priced in. I don't think these tariffs and the immigration orders are going to be much more significant than the market has already priced in. If they are, as I said, the market starts spiking and goes up towards 114, which is very, very bearish for equities, I think, because you get a double tightening. You get a tightening from the dollar and you get a tightening from bonds as well, because they start spiking up in yield. So I'm a bit worried about that, but I really don't think that that is going to be the case. I don't think he wants to start his 4-year term by caving in all assets, because that is what he'll be doing. He'll be caving in all assets. The reason why I'm not hugely bullish of the dollar at the moment is that I think it's far more likely, and this is the Euro currency index, that we test this 104.60 level, which is so significant. And if we can't break it, that means that we front run it and we've now back here, but from there it can start really going again. We will see. I am not long of the dollar at the moment. I think the Euro Japanese yen is the one that will break down if things aren't as bad as the market thought, and therefore I'm always looking for this to go back to 104.60, because that is where I think option strategies on the euro are really going to pay off. Straddles, when we hit 104.60 here on the euro, I mean, either we're going to go straight back up to 112 or we're going to go in time down to 96. And these are big moves, and I think it's going to come to the downside, but from 104.60 would make more sense to me, because too many people are long the dollar at the moment. And let's stop those out, because the executive orders aren't worse than we expected, but from there, let's go down. Well, since we all know that the indices are dominated by the big tech companies, there's really nothing else to look at for levels apart from the NDX. And it keeps on bouncing off this 20,600 level, and until it breaks it, and you can see the 200 period moving average is there as well for support, there is absolutely no reason to think that SPX can go down. And let's have a look at SPX here, that SPX can go down more than the levels that I marked down, which is basically the 58.60 level. And there we have the 200 period moving average as well. It seems that every time we go there, and we, even we spend half a day outside of it, we still bounce by the end of the day, and we really can't go much lower. So this to me is a sign that people are still preferring equities to bonds, that the economy is still strong, and that people don't see any reason why they should switch out of equities into bonds. Now, that might change, but it's not changing at the moment. We are still having the expectation of policies which are inflationary, i.e. the tariffs and the immigration orders, and therefore people are still not doing it. Now, they might do it, who knows, in several months' time. And if there is no counter twist, as I was telling you, from Besant at the QRA, then it's unlikely that bonds can move enough to bring equities down. And therefore, people will continue to be neutral on bonds. I don't think they go much higher than that 5% without that counter twist. But why would people not buy equities? Because that will be a message that no, we don't want to cave in the stock market. We are not doing the counter twist, and therefore bonds are going to be stable and they are no longer going to be such a headwind for equities. So unless the market starts breaking down in the high beta stocks, which is the NQ, and we start breaking this 20,600 level, why would you expect XPX to go down? And I showed you before the chart of SPY TLT, and that basically now SPY and TLT are the same thing. Well, as soon as that relationship breaks, I think that we can start going upward and NQ starts taking out the 22,000 level, and then it goes on one of these runs after the QRA most probably. But I just don't see that equities are a sell at the moment. I prefer to have calls rather than outrights, but that's because volatility is relatively cheap on the skew, and also there is always the danger of Trump doing something crazy, whereby you are offside 3-4% for no reason whatsoever. So I think volatility is cheap, and therefore options are a better way to play this. But at the moment, unless bonds start breaking that 5% area for a good reason, and the twist, the counter twist would be a very good reason, then I don't see why equities are going to do anything but try the upside after the QRA. And I really would expect that after the QRA, unless there's this counter twist, we start making new highs in SPY TLT and in the equity indices. Just one last word about sectors. It seems to me that XLF is by far the most bullish sector. It's the only one that hasn't really filled the gap from the election night. And after a long period of consolidation, it's going higher. If next week it doesn't fill this gap around 49 down to 48.50, it'll be a big sign that it wants to lead and that you want to watch XLF as opposed to any other sector. What are the implications of XLF leading? Well, XLF likes a steep yield curve, and it also likes easings. So it's probably an indicator that the Fed at some stage cuts rates and that the yield curve gets steeper, or that the market is expecting that, and that lots of deals take place, i.e. mergers, acquisitions, a strong economy basically. And that has to tell you that the yield curve steepens when the Fed eventually cuts, but also that the long end does not go much worse, i.e. that it's a bull steepening as opposed to a bear steepening. And also it should tell you that the economy stays robust and that there's plenty of deal making and plenty of money for the financial institutions to be made. That is the implication of XLF leading, which is good overall for stocks. Really, that's all I have for you. Let's see what the Trump executive orders are, analyze them, and then make a decision. But to me, it seems still equities over bonds, with stability in bonds being all that equities need at the moment to do better. Thank you very much indeed, and I will tweet you tomorrow.